There's a shift happening in the silver market right now that you've never seen before. It's so dramatic, it challenges everything you've been told about financial stability. Silver, usually predictable and stable, just shattered a major psychological barrier. American silver eagles are now priced at $100 each, not the spot price. $100 is the new reality for physical silver, and this isn't some fleeting spike, it's the new floor. This change has happened in just 48 hours, and here's the real kicker. It's not just about silver, this is a sign of something much bigger. Jerome Powell, the chairman of the Federal Reserve, is under criminal investigation by the U.S. Department of Justice. This is no routine inquiry. This investigation is shaking the very foundations of the financial system. While the mainstream media sticks to the usual narratives, the physical silver market is sending a clear message. This is about trust or the lack of it. So why does this matter to you? Because this investigation has set off a chain reaction across financial markets, and silver is right in the middle of it. I'm going to walk you through why this isn't just politics or noise. This is a crisis, and if you don't understand what's happening now, you could miss out on the biggest financial shift in years. Now, here's what they're not telling you. While you were relaxing this weekend, the Department of Justice launched a full-scale criminal investigation into Jerome Powell, the man in charge of the Federal Reserve. And this isn't some minor inquiry. It's serious. They're investigating his 2024 congressional testimony and questionable renovation expenses that raised major red flags. The media, they're calling this a minor blip. They want you to believe the Fed is still in control, still steady, still independent. But here's where things get wild. The physical silver market just gave a middle finger to that narrative. The American Silver Eagle, the benchmark 1-ounce coin that every serious stacker watches, just crossed $100 at major dealers. Now, let me be crystal clear. I'm not talking about the spot price. The spot price is still sitting at $85.955. What I'm talking about is what you actually pay to get physical silver in your hands. $100, and that's not a one-off. This is the new reality, the new floor, and it happened in less than 48 hours. For the first time in my career, we're seeing a complete disconnect between the physical silver market and the paper markets. And why? Because the DOJ's probe into Powell has shattered the illusion of the Fed's independence, and that loss of trust has triggered an overwhelming rush into hard assets, silver being one of them. So what does this mean? Silver is no longer just a commodity. It's a crisis proxy. Investors are fleeing to it as a hedge, and the physical market is completely decoupling from the paper market. Let me show you what that means. Silver is no longer about what the paper price tells you. It's about what's happening in the real world right now, where the premium on physical silver is climbing fast. Let's break it down further. While you're still looking at $85 on the screen, what you're really paying for silver in the real world is $100. And that's not some temporary spike. It's a new stable floor. So what's happening here? How is it possible for the physical silver market to behave this way while the paper market stays behind? This is what I call the premium gap, and it's happening right now. You see, there's a huge divergence between the spot price, which is just paper contracts traded on exchanges like COMEX, and the physical price, the price you actually pay to hold silver in your hand. Here's the kicker. Most of those paper contracts don't actually result in real deliveries. They're just bets on the price of silver, with traders closing them out before they ever have to take delivery. It's essentially a casino. But physical silver? That's real. It's finite. It has to be mined, refined, and stored. It can't just be printed with the click of a button. So when demand spikes, the price has to rise to meet that demand. And that's exactly what's happening now. The silver price in the physical market isn't controlled by paper traders. It's controlled by scarcity. Dealers are selling out faster than they can restock, and prices are climbing because there's simply not enough silver to go around. And this disconnect between the paper and physical markets is exactly what the major players, central banks, sovereign wealth funds, are trying to exploit right now. This isn't just a retail phenomenon. This is institutional money flooding into silver. They're not buying for speculation. They're buying for survival. Now, here's where things get interesting. There's a rumor circulating on institutional desks right now about something called the LBMA short squeeze. If that's true, and I'll show you the data that suggests it might be, we're not talking about $100 silver. We're talking about $150 silver in hand, while the paper price still sits at $100. This is exactly how the premium gap works, and it's why the price of silver is about to explode. Let's dig deeper into the numbers. I pulled some data just a few hours ago. As of 2:01 p.m. Eastern Standard Time, gold hit a new all-time high, 4,610.54. Silver was up over 7% in just a single session, closing at 85.55 on the spot. But here's the real shocker. While the spot price was showing $85, every major dealer in the U.S. had already moved their American Silver Eagles to $100 or higher. Some dealers listed them at $102s, even $105. The smaller regional dealers were even higher, scrambling to restock because they had already sold out. Stop for a second and think about this. The spot price is $85.55, but the physical price, $100. That's a 17.5% premium. In a normal market, premiums on Silver Eagles run around $3 to $5 over spot, maybe $8 if supply is tight, but 17%, that's not normal. That's a massive glaring divergence between what the paper market tells you and what the real price is. This isn't just a temporary glitch. This is a sign of a major shift. And here's where it gets even more concerning. I spoke with a contact at a mid-sized dealer in Texas, and he told me that his weekend order volume was 4 times his normal Saturday traffic. People were buying anything they could get their hands on, eagles, maples, even generic rounds. It didn't matter. They just wanted silver before the $100 barrier drove people away. This is a buying frenzy driven by fear. And that fear, it's not just about silver, it's about the system as a whole. The premium gap is widening because of a huge shift in market behavior. People are realizing that the paper markets are a lie. They can't keep up with the real-world demand for physical silver. And the worst part? Most investors don't even understand this mechanism. If you're only watching the screen price, you're getting misled. The real price? It's in the dealer's inventories, and it's climbing every day. Now, let me explain the key mechanism behind this so you don't get caught off guard. It's what I call the premium gap. And it's the reason why the physical price is moving faster than the paper price. The market for silver futures, those contracts traded on COMEX, is a paper market. The spot price you see every day is derived from futures contracts that give traders the right to take delivery of silver at a set price on a specific date. But here's the catch. Most of those contracts don't result in physical delivery. They're just bets. The contracts get closed before anyone actually takes possession of the metal. Now, contrast that with physical silver. When you buy a coin, a bar, or any form of silver, you're buying something real, something that has mass, that has to be mined, refined, and stored. It's finite. When everyone suddenly wants it at the same time, the price has to rise. The price on paper, that's just a number on a screen. The price in the real world is dictated by scarcity. And right now, that scarcity is pushing the physical price to new heights. Think of it like this. Imagine a concert ticket is listed for $85 online, but when you go to buy it, the website tells you it's sold out. Now, if you really want to go to that show, you've got 2 options. You can wait and hope more tickets are released at $85, or you can step outside the venue where scalpers are selling tickets for $100. That $100 is the real price, the price that reflects what people are willing to pay to actually get into the concert. The $85, that's just a number that doesn't reflect the reality on the ground. That's where we are with silver. The paper price on COMEX says $85.55, but if you want physical silver, you're going to pay $100 or more. That's the real price, the price you actually pay to get your hands on it. And here's the trap. If you're only looking at the screen price, you're going to miss the point entirely. If the price dips back down to $80 next week, don't think that means silver is cheaper. The dealers will still be charging $95 to $100 for the physical silver because the supply hasn't returned. The paper market is controlled by institutional players who want to keep the price low. But the physical market is telling you the truth. And the truth is silver is much more expensive than the spot price is showing. And here's the part that's really important. The gap between the paper price and the physical price is only going to widen from here because there's a rumor circulating right now about something called the LBMA short squeeze. The London Bullion Market Association, one of the biggest players in the precious metals market, is facing a potential delivery default. That means a major institution, possibly a sovereign wealth fund or a central bank, placed a massive order for physical silver, and the vaults can't deliver. They don't have it. They've been selling paper claims on metal they didn't own, and now someone's calling their bluff. I can't verify this rumor yet, but what I can tell you is that the massive price premiums we're seeing align with the possibility of a delivery squeeze. And if that rumor turns out to be true, here's where things get really interesting. If the institutions can't get their hands on the metal at the paper price, they'll start bidding up the physical market. And when they do that, guess what happens to retail buyers like you and me? We get priced out. Now, let's run the math on this. I'm going to give you two scenarios, one conservative, one more extreme. First, the conservative scenario. Let's assume the premium gap stays at 17.5%. If silver spot price reaches $100, that means the physical silver coins would be priced at $117 for a coin that the screen says is worth $100. That's a 17% markup, which is already huge. But then let's look at the extreme scenario. If the LBMA short squeeze is real and the delivery defaults escalate, premiums could hit 50%. I know that sounds insane, but it's happened before in other commodities during times of crisis. If premiums hit 50%, the price of physical silver could reach $150, even though the spot price still shows $100. That's a $150 coin, while the paper market is still showing $100. And here's why I think this is more likely than you might think. I've been watching the technical indicators closely. As of a few hours ago, the relative strength index, RSI, for silver hit 77.9, which is in overbought territory. Historically, when the RSI goes above 70, it's a warning sign that a pullback could be coming. Traders will start thinking it's time to sell, take profits, and wait for a dip. That's the conventional wisdom. But here's the thing. The physical demand for silver doesn't care about technical indicators. It's screaming overbought, but dealers can't keep silver on the shelves. That tells me this isn't just a regular technical rally. This is a fear-driven accumulation event. People aren't buying silver because they think it's going to $90. They're buying because they think the financial system is breaking. And then there's this anomaly. The US dollar index, or DXY, is showing surprising strength. Usually when the dollar strengthens, precious metals like gold and silver fall. That's Econ 101. A strong dollar equals weak metals. But right now, both the dollar and gold are rising. Gold just hit an all-time high of 4,610, and silver is up 7% in a single day. That shouldn't be happening unless this isn't just a currency play. This isn't about the dollar. This is about a broader flight into hard assets. Money is fleeing from risk assets and into anything tangible. People are looking for safety, and right now, silver is one of the only places they can go. The numbers don't make sense in the context of history because the history books never accounted for this kind of systemic crisis. A Federal Reserve chairman under criminal investigation, that's a variable no one has priced in. The Fed's independence has always been an illusion, but it was a useful illusion. It kept the system stable because people believed the Fed was above corruption. Now that belief is gone, and once trust evaporates, price discovery gets messy and violent. Now, I know what the skeptics are going to say. I've already seen it in the comments on other channels. This is just a politics-driven rally. Once the DOJ investigation fades and Powell is cleared, silver will crash back to $70. They'll claim this is just retail hype fueled by fear-mongering YouTubers. And I get it, I really do. It's easy to dismiss a rally when it's driven by emotion, but here's where they're wrong. Retail investors can't move markets like this, not at this scale. Retail doesn't have the capital to push silver's price like we're seeing right now. This isn't just a retail-driven rally. I saw a report from Morgan Stanley just last Friday. They flipped their entire commodity strategy. They're telling their institutional clients to buy silver as a hedge against fiscal risk. When the big banks start recommending something they usually tell you to avoid, it's because their risk models are flashing red. Morgan Stanley doesn't care about silver. They care about making money for their clients. And if they're telling their clients to buy silver, you better believe they're seeing something big on the horizon. Now, let me address another myth you're going to hear. The idea that higher interest rates always mean lower gold and silver. You'll hear that on CNBC, right? The Fed raises rates, so gold and silver fall because they don't pay yield. It's a simple narrative, but it's wrong. Let's take a trip back to 1979 and 1980. The Volcker Fed raised interest rates to a staggering 20%, and guess what happened? Silver went to $50 an ounce, an all-time high at the time. Why? Because the market didn't trust the Fed. Rate hikes weren't seen as a sign that the Fed had inflation under control. They were a sign that inflation was completely out of hand. If we see a similar situation today where the Fed raises rates to restore its credibility, it might have the opposite effect. Instead of calming the market, it could send a clear signal that they're panicking. And if the DOJ probe continues, every rate hike could look like a desperate attempt to save face. And that, my friends, could send silver prices even higher. Let me take a moment to recap and set the stage for what's coming next. We've seen the physical silver break out to $100, which signals a huge shift in the market. We've explained the premium gap and why it's happening. Paper prices are out of sync with reality. We've also broken down why the DOJ investigation into Powell is a trust issue, not just political noise, and why that's triggering the rush into hard assets. But here's the real question. What happens next? The first thing to watch is the institutional reaction, specifically the COMEX, where the paper market is heavily concentrated. As the paper market starts losing control of price discovery, we can expect the exchange to do what they've always done, hike margin requirements. This forces retail traders who are long silver futures to either post more cash or close their positions. It's a way of shaking out the weak hands. Every time the COMEX hikes margins, we see a temporary dip in prices as traders panic and liquidate. If they announce a margin hike within the next week or two, you'll see silver pull back, maybe back to $80 or even $75. And when that happens, the media will scream, "See, the rally is over. Silver is crashing." But if you understand the mechanism behind this, you'll know it's a temporary dip. The physical price of silver, the price you pay at dealers, won't be following the paper price down. In fact, the $100 floor on physical silver will likely hold, and as soon as the dip is over, we'll see prices surge once again. But there's another factor to watch closely, the gold to silver ratio, or GSR. Right now, the ratio stands at about 54 to 1, meaning it takes 54 ounces of silver to buy 1 ounce of gold. Historically, when the ratio falls below 50, it's a sign that silver is outperforming gold. And when that happens, silver mania kicks in. If we see the GSR break 50, get ready for a massive rally in silver. And this won't just be a niche event. It will be a mainstream story with retail investors flooding in and driving prices even higher. Now, let me paint a picture of what could happen if the gold to silver ratio breaks 50. When that happens, it signals that silver is entering a new phase of mania, something most investors aren't even prepared for. This is when the retail buying really kicks off, and that's when the premiums could go completely parabolic. Imagine paying 40%, 50% premiums on silver coins as panic buying sets in. It's not just about the price of silver anymore. It's about the psychological shift that comes with it. Once the masses start catching on, everyone's going to want in. But the thing is, by the time silver is hitting those levels, you'll be competing with institutions, central banks, and sovereign wealth funds who are all making moves to secure silver while they still can. That's when it gets dangerous, not because silver crashes, but because the premiums get out of control. You could be paying $150 for a coin while the spot price still shows $100. The media will start scrambling at that point. They'll do everything they can to downplay the situation. Expect the coordinated silence at first. The big networks won't talk about silver because it's inconvenient. It